Hey everyone, and welcome back to the channel. Today, we're diving deep into the glittering world of precious metals. Gold and silver have been on a fascinating ride lately, and a lot of you have been asking for a detailed breakdown. So, is now the time to buy, sell, or hold? Let's get into it. First up, let's talk about the big picture. For months, the narrative has been dominated by central bank policies, inflation fears, and geopolitical tensions. These factors are the classic drivers for precious metals, often seen as safe havens in times of uncertainty. When traditional assets like stocks or bonds feel shaky, investors tend to flock to gold and silver, pushing their prices up. Let's look at gold specifically. We've seen some incredible movements. A key factor has been the action of central banks around the world. They've been buying gold at a historic pace, building up their reserves. Why? It's a strategy to diversify away from the US dollar and hedge against economic instability. When institutions with that much buying power are in the market, it creates a very strong floor for the price. This isn't just a trend, it's a major structural shift in the global financial landscape. Another huge piece of the puzzle is interest rates. Typically, when interest rates are high, non-yielding assets like gold become less attractive. You could just put your money in a high-yield savings account and earn interest with very little risk. However, what we're seeing now is a bit different. The market is starting to anticipate that central banks, particularly the Federal Reserve in the US, might have to pivot and start cutting rates sooner than expected to avoid a major economic slowdown. The mere expectation of rate cuts is bullish for gold. As soon as those yields start to come down, gold suddenly looks much more appealing in comparison. Let's zoom in on the technical charts for a moment. Gold has been testing some major resistance levels. Breaking through these psychological barriers is crucial. A sustained move above these key price points could signal the start of a new, powerful uptrend. On the flip side, these levels could also act as a ceiling, leading to a temporary pullback. Watch these levels closely. A pullback could present a strategic buying opportunity for long-term investors who believe in the fundamental story. The support levels below are just as important. A break below those could indicate a short-term trend reversal. Now, let's shift our focus to gold's spirited sibling, silver. Silver is often called gold on steroids for a reason. It tends to be more volatile, meaning its price can swing more dramatically in both directions. While silver also acts as a monetary metal and a safe haven, it has a dual personality that gold doesn't. A huge part of silver's demand comes from industrial applications. It's an essential component in everything from solar panels and electric vehicles to smartphones and medical equipment. This industrial demand is a massive driver of its price. As the world pushes towards green energy and further technological advancement, the demand for physical silver is set to explode. The green revolution is, in many ways, a silver revolution. This is a powerful long-term tailwind for the metal that isn't going away. However, this industrial side also makes silver more sensitive to the economic cycle. If there's a global recession, industrial production slows down, and demand for silver can take a hit, putting downward pressure on its price. This is the delicate balancing act that silver investors have to navigate. One of the most talked about metrics in the precious metals community is the gold to silver ratio. This ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has fluctuated, but when it's high, it suggests that silver is undervalued relative to gold. Many investors use this as a signal. They might sell some of their gold to buy silver, betting that the ratio will eventually mean revert, or return to its historical average. Watching this ratio can offer clues about which metal might have more upside potential at any given moment. So, what are the current headwinds and tailwinds for both metals? For gold, a major tailwind is the persistent global uncertainty and central bank buying. The headwind? A surprisingly strong dollar or higher for longer interest rates could temporarily cap its gains. For silver, the industrial demand from green technology is a massive tailwind. The primary headwind is its sensitivity to a potential economic slowdown, which could dampen that same industrial demand. Let's talk strategy. What does this all mean for you? As always, this is not financial advice, and you should always do your own research. But here are a few ways investors are approaching this market. One common strategy is dollar cost averaging. Instead of trying to time the market perfectly, which is nearly impossible, investors buy a fixed dollar amount of gold or silver at regular intervals. This way, you buy more ounces when the price is low and fewer when it's high. Over time, this smooths out your average cost and reduces the risk of buying everything at a peak. Another approach is to look at precious metals as a long-term insurance policy for your portfolio. A common allocation is around 5 to 10% of your total investment portfolio. The idea isn't to get rich quick, but to preserve wealth and hedge against inflation and a potential crisis in the currency system. In this view, short-term price fluctuations are less of a concern. For those with a higher risk tolerance, trading the volatility, especially in silver, can be an option. This requires a much deeper understanding of technical analysis and a very active management style, as silver's price swings can be brutal if you're on the wrong side of a trade. It's also crucial to consider the form in which you buy. You have options like physical bullion, coins, and bars, which you can hold yourself. This offers the ultimate security against system failure, but comes with storage and insurance considerations. Alternatively, you can invest through ETFs or exchange-traded funds, which track the price of the metal. These are highly liquid and easy to trade in a standard brokerage account, but don't give you direct ownership of the physical metal. There are also mining stocks, which can offer leverage to the metal price, but also carry company-specific risks. So, where do we go from here? The consensus among many analysts is that the long-term outlook for both gold and silver remains very positive. The fundamental drivers, debt, money printing, geopolitical risk, and the green energy transition are firmly in place. However, the path won't be a straight line up. We should expect volatility, pullbacks, and periods of consolidation along the way. For gold, keep an eye on central bank announcements and inflation data. For silver, watch manufacturing PMIs and news about green energy investments in addition to the monetary factors. The interplay between these forces will dictate the price action in the coming months. It's an exciting time to be watching this space. The dynamics are constantly shifting, and understanding them is key to making informed decisions. The story of gold and silver is an ancient one, but it's more relevant today than ever before. What are your thoughts? Are you buying, selling, or holding? What's your favorite way to invest in precious metals? Let me know down in the comments. I read every single one and love hearing your perspectives. That's all for today's deep dive. If you found this analysis helpful, please give this video a thumbs up, and don't forget to subscribe and hit that notification bell so you do not miss our future updates. Thanks for watching, and I'll see you in the next video.